That's got to be fun. He'll lose his hair.
Welcome, everybody. Okay, guys, we're going to get going here, and quickly say hello and hand the mic off to Peter, who we really came to see. So, appreciate you guys and ladies coming out for an afternoon in August to hear the story, and from American Pacific and from on behalf of Cantor Resources as well. We appreciate you being here. Certainly appreciate Peter Krauth coming through. It was very last minute with our friend Peter Grandage coming down with COVID. So very, very happy to have Peter here, and excited to see the presentation. So probably 20 or 30 minutes from Peter. We can do a Q&A afterwards if you like. Anything company related, Jonas or myself can answer. Peter can tell us what's going to happen next outside of that, and then we'll have food coming out after that. So please enjoy. Thank you so much for coming, Peter.
Thanks, Warwick. Thanks to everyone for being here. Like Warwick said, thanks for taking some time out on a nice August day. I want to thank American Pacific, Cantor, and High Tide for putting on this event today, and for giving me the opportunity to come in and speak to you as well. And for Peter Grandage, I'm glad I was able to step in and hope that he feels better soon. So my talk today is the new commodities bull market, cause, effect, and opportunity. Just before I get started, just a little quick background on me. I write a silver-focused investment newsletter. It's the only silver newsletter that I know of. And I recently partnered with Jeff Clark, whom you may know, who is behind the Gold Advisor, and which is a free letter, and Pater Prospector, which is also a paid newsletter. So I'd like to start off with this quote, which is, there are decades where nothing happens, and then there are weeks where decades happen. Now, I put Vladimir Lenin below there with a question mark, because in my research, I could not attribute that to him. It's often attributed to him, but apparently there's no definite connection. Not exactly my hero, but nonetheless, whoever said it was wise, and I feel it's very apropos right now, so I thought it'd be something to start off with. So, I think that we are really entering a period of a lot more volatility. This week, Monday, was quite stunning what happened. We're already Thursday and things are looking better, but it's not something I would put in the back of my mind, on the back burner. This sudden volatility, I think, is a sign of things to come. Just think about what happened in one day. The yen, so we'll start off with about 2 or 3 months perhaps before. The yen had gained about 13% against the US dollar in 3 weeks. That's just phenomenal in the currency markets. So partly, I guess what kind of was the cherry on top was when the Bank of Japan increased rates, and together with the expected cut from the Fed. So that led to a major sudden unwind in the yen carry trade. Japanese stocks had their worst day since 1987's Black Monday. The Nikkei was down 12.5% on a single day, its largest one-day point drop. The S&P was down 3%, 6% in those 3 trading days. Just 10 of the S&P stocks were the equivalent of $2 trillion since mid-July. And the Nasdaq was down 3.5% that day, and those 3 days, the 2 prior included, was down 8%. So again, as I say, I think that's a sign of things to come. And what's causing all of this? Well, in my view, it's debt. So globally, debt is just rising. If you look at what happened, let's say from around 2010 after the financial crisis, there was actually a drop in debt for a little while. The debt to GDP ratio, and then started to rise again. And then the forecast from sort of between 2015 and 2020, this is according to the IMF, the lighter red line, the lighter blue line is actually what they were projecting at the time. And so for both advanced economies, for emerging markets, those debt to GDP ratios were rising, and then COVID hit. And then you had this blast of inflation, this blast of money printing, coordinated worldwide, and look what happens with the charts. They just go nearly vertical, despite emerging markets, being at a lower, clearly a lower debt to GDP ratio than the advanced economies. They started to rise considerably as well. They both continue to rise, and that's not about to end anytime soon. But it's certainly causing a lot of problems. The US alone, we recently crossed $35 trillion in debt. I mean, just a mind-boggling number that is pretty much impossible to comprehend. And sadly, because it's so big, we don't even try anymore. Well, the US now, according to Bank of America strategists, is adding $1 trillion of debt every 100 days. So again, the trend continues. We're now at a point that because of high inflation, because of messing around with interest rates so much, the Fed was in the most aggressive rate hiking cycle in something like 50 years. Bonds are no longer the safe haven. So treasuries now have become more volatile than gold. It's the first time we've seen that happen in 45 years. So we talked about the cause, now the effect. Well, the effect is inflation. That's clear. What we know is that from about the financial crisis until about 2020, inflation averaged about 2% in the developed economies. And then COVID hit, and we had this coordinated money printing, as I mentioned before. And now it looks like we have structural inflation that's starting to set in. And that comes in many parts. The largest part probably is labor. And I don't know how this works, but people don't seem to want to work. They complain about inflation, but when you try to hire someone, they're not interested and they have all these conditions. I just don't get the math there. But they seem to have pricing power. Nobody seems to want to work. When you can finally find someone, they have pricing power. So that's a big part of structural inflation now. You have the end of globalization. COVID has caused countries, people, companies, governments to want to become more self-reliant, and so globalization to some extent is sort of retreating. You've got the energy transition that is quite entrenched, and then you've got defense spending that, because of everyone's fearful of everyone else, is also being taken up a notch. So now, where you had inflation post-financial crisis for about 10 years at about 2%, now we're probably looking on an ongoing basis at more like 4 to 4.5%. I've been saying for at least a couple of years that it would not surprise me within the next year or two, we're going to start to see central banks in developed countries start to raise their target from 2% to 3%. So we're no longer going to hear about, we're trying to aim for 2%, give or take. It's going to start to be more like 3%. And they're going to have all sorts of explanations for it, but bottom line is it's going to make their life easier, and it's going to lead to financial repression and make everyone else's lives more difficult when you try to be a saver, especially in cash. So if you look again historically, inflation is really, really tough when you're trying to make a return after inflation. This goes back to 1900, so you have that period in the early 1900s when you had high inflation. So this is actually 10-year returns, annualized returns of a US 60-40 portfolio. So what you can see is that portfolio mix really, really struggled when inflation was high. Early 1900s, that happened again in the 1970s. You're looking at a decade of -3 annual real returns in the 60-40 portfolio. So 70s were resolved, inflation was resolved. So then you had low inflation for nearly 40 years after that. Stocks were fantastic, bonds were fantastic, and I believe we're nearing the end of that kind of period, and that it's going to be very difficult to make some real returns again in this new high inflation environment. This is one of my favorite charts. It looks back to about 1960, 65, and it shows the consumer price index in the US. Now, if you look way over on the right, where I have that number 1, that's what happened in the last couple of years. So inflation spiked to 9% after we had this huge, orgy of money printing. And then it started to pull back. Obviously, we're closer to officially say 3.5%. But I think that because so many people today were not around in the 1970s or were too young to remember it well enough, think, well, okay, so it's a one-off, it's this big spike in inflation, the government, the Fed's all gonna fix it, and we're back to normal, and we can party on. I think that the spike that we had is going to look more like the first wave that we had in the 1970s. So what happens is you have this inflation, you have the central banks step in, they start to raise rates, it cools things off, and you get that dip below the first one, and then it comes roaring back because it's structural, it's embedded. It starts to come back. You get the second wave. The Fed starts to become more aggressive again, raise rates, and then inflation dials back, and then you have another wave that comes back, and it's even higher than the previous wave. So, who knows? But if this is in fact the first of several waves, and it's as big as it was this time around, I hate to think what waves 2 and wave 3 might be like. In any case, I've been saying for a while, I believe we're in an inflation decade, probably even beyond that. So I think we're gonna see structural inflation till 2030, 2035 easily. And I think that the average person is starting to agree with that, because this is long-term inflation expectations by investors on a 5 to 10 year time frame looking forward. And so you can see that from sort of been around 2000 or so, 1999, all the way until say 2015, that was people never expected inflation to be much beyond 3.5%, maybe 4%. There was that little spike during the financial crisis. Other than that, we were very comfortable with seeing inflation at 3.5% as a high. And then it actually came down up until 2019. And I remember clearly the Fed in particular kind of not panicking, but just wishing that the same with the European Central Bank, just wishing they could get inflation back up to 2.5%. The economy was anemic. Well, they certainly got their wish. COVID came along, changed everything, and for a while, people were thinking, okay, well, it spiked up. This is in the last couple of years. So remember in 2022, inflation peaked at 9%. Even still then, people were only thinking the next 5 or 10 years we might see inflation at maybe 3.5%, 4%. 2 years later, with inflation back down to 3%, they don't see that anymore. They're now expecting that over the next 5 or 10 years, inflation will average more like 5 to 5.5%. So it's becoming embedded in people's minds. They're starting to feel that this is what life is going to be for the next 5 to 10 years. And there are consequences to that and actions that follow. So this is an interesting chart, one of my favorite. It looks at debt to GDP ratios, and I think it's really important because if you look at the 1970s, which is the best analog we have to right now, I think, because I believe that we're in the beginnings of a commodity boom, and we had one then, and as well, we're at the beginnings of, in an extended period of inflation. Well, in the 70s, the debt to GDP ratio was falling. And it ended at 35% by 1980 or 1982. Think about that for a minute. Central banks had to deal with the inflation. If debt to GDP is falling and is at 40 or 35%, someone like Volcker had a much, much easier time having to raise rates to kill inflation to 18 or 20%. Fast forward to today, and we're at 120% debt to GDP ratios. Imagine trying to do the same thing, running a central bank and saying, how high can I raise rates? Well, people panic when you bring it up to 5%. Imagine trying to do anything beyond 10 or 15. And that's what it took back then, with much lower rates. You simply cannot do it today. Governments are so indebted that if you were to raise rates that much, the money printing would be so fast and so exponential that the debt would just explode higher. It already is high, but it would just take it exponentially higher. This is really interesting because it shows how gold, going back to, the this correlation goes back way beyond that, but the chart is from 2006 to early 2024. And you can see that, so the lighter blue line is the price of gold, the dark blue line is the inverted 10-year real rate. So as real rates go up, in this case, it's because it's when they go down. But again, it's not intuitive, but as you see that dark blue line goes down, that means real rates are actually going up because the left side of the chart has been inverted. So when real rates go up, they compete with gold, so gold tends to go down. When real rates go down, gold goes up. Well, that relationship broke down in 2022, and for a couple of reasons. I think that the main one was really that central banks, in a coordinated way, got aggressive and started raising rates very quickly, and so that competed with gold to some extent. But then gold would have nothing of it, didn't buy it. They felt that they were basically gold was calling the bluff on central banks and said, we don't believe that you can sustain these low rates. We believe you're gonna have to, these high rates, we believe you're gonna have to start cutting. And real rates will come down as a consequence and support higher gold prices. Well, I think that scoop up at the bottom on the right is what we're starting to see now. Real rates are starting to fall. We've gotten, people calling, just from this past Black Monday, we've gotten people calling for an emergency rate cut. I'm not sure that's going to happen. September's not that far off, but anything can happen. But essentially gold's calling the bluff on central banks. And the fact that gold has continued to rise and so consistently means gold is very, very confident that real rates are going to start falling. This shows you, this shows you the amount of buying from central banks going back about the last 14 or 15 years. And what's really interesting, the last two gold bars are the amount of buying by central banks 2022, 2023. So there are a couple of reasons actually for this. First of all, just the raw numbers. So the gold market is about 4,000 or so tons, give or take, every year. Central banks bought over 1,000 tons in the last 2 years. So if you think about that, it's, in simple terms, 1 out of every 4 ounces of gold was bought by a central bank. That is just phenomenal, off the charts. I believe there's 2 things that they see coming. Let's put 2, well, perhaps 3. 2 of them I can put together. Inflation, they see continuing, and some kind of a monetary reset. And so they're protecting themselves by loading up on gold. The second thing is that they saw what happened when the US froze Russian assets, Russian treasuries, and all sorts of other assets. And they just basically said to themselves, we don't want to get caught the same way. So we're looking for something that is liquid, will be accepted by anyone. On top of it, it's anonymous. Let's load up on gold, and that's what they've been doing. And I think this is also the start of a new trend that's very likely to stay very, very, very strong. So it's not just central banks that are cluing in on this. The average investor is really starting to clue in as well. This is an interesting headline. I go to Costco every week, every Saturday morning, and I walk in there, I see that silver 10-ounce bar, and I see that gold 1-ounce bar, and the price just keeps going up. Well, Costco now sells the equivalent of about $1.5 billion of gold, just of gold and silver, every year, $200 million worth per month. So, as I say, the average investor is really starting to clue in, and by the way, they don't take it back. So you have to find someone else to buy it from you. That's the one thing Costco will not take back. Gold during rate topping cycles. This is very interesting, a chart put out by Incrementum. So what they did was they looked at what happens to the price of gold when central banks, the Fed in this case, reaches a pause in rate hikes. So the red circles at the top is each time you hit the top of a rate hiking cycle. They would raise rates and then stop raising rates and then leave rates high for a while. Well, that's when gold takes off. Gold starts to rise when central banks stop raising rates. And if you look at the average, the last 3 periods when that happened, going back to 2000, Gold averaged gain of over 50%, I think it was 57% the last 3 times. Tremendous run. So I looked at that, and then because I specialize in silver, I said, let me, create the same chart for silver. This is amazing. If you look at, so silver does the same thing but with a lag. Silver will start to rise, but not until the central banks start to cut rates as opposed to pausing. So about halfway through the rate cutting cycle, silver will take off. And in the last 3 rate cutting cycles, if you look at the average, silver gained about 350% average for each of those rate cutting cycles. Just again, tremendous returns. So all of this, we have to be able to do something with it. And I believe that what this means is that, the debt, rising debts and the effect being inflation have led to a massive opportunity in commodities. Specifically, 1970s, look at gold and silver. They absolutely trounced stocks. Stocks were flat for 10 years, even if you, without factoring in inflation. It makes sense, public companies have to borrow, they have to operate. During inflation, wages rise, so their costs go up. Everything goes up in terms of costs. They struggle to keep their profits at the same level of growth. Gold in that period was up 1,400%, silver was up 3,700% in a decade. So it tells you what commodities do during inflation. And not just during inflation, because if you were to ask just about anyone, what has been the best general sector to be invested in going back to 2000? Almost invariably you get stocks as an answer. Well, stocks did okay, up about 250%, that's the Dow and the S&P. Silver was up 470% or so. Gold has been up since then, about 700%. So the last 25 years have been phenomenal in gold and silver, just the metals, straight metals. We also know from history that inflation is very, very conducive to commodity bull markets. So if you go back 100 years, you look at each of the 4 prior commodity bulls, with one exception, and you could still argue it's somewhat inflationary, but the early 1900s, the 40s, the 70s, all inflation-driven commodities bulls. 2000 to 2010 was at least in large part driven by the manufacturing boom in China. But you could argue there certainly was plenty of money printing that took place, and they kept rates relatively low. It was quite inflationary then as well. And so you had a strong commodity bull market. We've been going sideways for about 10 years almost now. We're pretty much due, especially with a new rate cutting cycle about to kick off. This is very revealing. If you look at, this is supposed to be smart money. Survey by UBS Global, along with CNBC, they looked at what U.S. family offices are due for their strategic asset allocation. They're right now only exposed to the level of 1% in commodities. It's just incredible. It's so undervalued, it's so disregarded. The sector is just ripe to take off. This is another great chart put together by Incrementum. It goes back to 1900 or so. And it's basically, it's the commodities to total return to the S&P ratio. So you can see there have been multiple spikes, and the peaks of those spikes are usually towards the end of these big commodity cycles. That's when commodities become wildly overpriced and stocks become wildly underpriced. Well, that happened at the peak of the financial crisis. The bottom, by the way, this is important. There was a bottom that was around 1999, 2000 or so. Commodities were dirt cheap, as you know. Stocks, and especially tech stocks, the whole internet craze, stocks were wildly expensive. And that was the start of a fantastic run in commodities. At the peak of the financial crisis, we had commodities peak. As we know, we've been through a bear market. Some may argue it's not quite over. I believe it's so early, and we've had such a small relative rise since it's easy to disregard, but I think we have seen it start and kick off. And I believe that commodities versus the S&P, for example, is an easy trade for the next 10 to 15 years. Some of the effects of a commodities bear market naturally is going to be mining capex falling, and that we've seen. It peaked in 2012. It fell dramatically right after. The next few years rose a little bit until about 2021. This is partly forecast. The next sort of 3 years are being forecast by S&P Global Intelligence, Global Market Intelligence thinks that we're going to see capex, mining capex, continue to fall. So that's not going to be helpful to bring more commodities to market, which is something that, you know, there's a way to play the other side of that. It is going to lead to copper shortages. If you look at this research, tells us this is the IEA by 2025 versus 2026. Expect a copper shortage to rear its head. The zinc shortage, same thing. Probably a small surplus 25, 26, but then 2027. You know, zinc's important. Galvanized steel makes solar panels more efficient. It helps to make batteries smaller and lighter. You know, the supply chain for zinc is being squeezed. And so, again, just, you know, these crucial metals in so many ways in daily life, just we do not have the infrastructure set up to bring them to market. Lithium had its run, and it's going to face a shortage as well, probably a year or two farther out before, more than the other metals, but certainly with EVs, with all of the applications that you have with the electronics and so on, lithium you can expect will have its day before long once again. This is another interesting chart. It's the NASDAQ 100 versus commodities. So kind of going back to what I was saying earlier, you know, stocks peaked in 2000. The NASDAQ had this crazy blow off up to 2000, 2001. That was the time to buy commodities, and they just ran for a decade. You could argue this is only February 2024. Since then, it's probably gotten even more overvalued. We are very likely peaking once again in that relationship, in that ratio. And tech stocks look wildly overvalued, commodities look wildly undervalued. Interesting comparison here. So the green bar is Apple's market cap. It's actually, so this is just a little bit dated, it's from the end of 2023. It's actually more like 3.2 trillion, I looked it up. So you compare that to the entire silver, gold, copper, precious, and diversified metals and mining industry. The entire industry has half the market cap of Apple alone. It's just incredible. I mean, if you're looking for value, this is value. So, kind of like mining capex, exploration budgets have been falling. They peaked along with commodities prices in 2012, fell, have been rising a little bit, but they're nowhere near the levels where they need to be. M&A is really going to be the key. That peaked in about 2012 finally, 2011, 2012, fell off sort of gradually and then more rapidly, and I think that's really where the opportunity, this is an interesting one. The white line is aggregate cash flows from operations from gold and silver miners. So you can see what happened 2009, 10, 11, 12 with the run-up in prices for especially gold and silver. Their cash flows just exploded. And so they went shopping. They almost completely disregarded any value, and there's all kinds of stories around that. And I'm not gonna start judging all of that. I'm just gonna state some facts here. Cash flows went crazy, and they went on a shopping spree. So the green bars are aggregate net acquisitions. So these gold and silver mining companies, rich with cash, went out and bought all sorts of things. And then the price obviously dropped off, and then the cash flows dropped off. But the really interesting part to remember about this chart is in 2019, those cash flows bottomed and have begun to take off again, along with the prices of gold and silver. So now these companies are cash rich, but they're gun shy. They're afraid to pull the trigger. They've been burned, they burned themselves, but The point is that there's this huge gap that needs to be filled. They have not been spending on CapEx, they have not been spending on acquisitions, they have not been spending on exploration. So the green bars all the way on the right show you the net acquisitions in the last 2 or 3 years, and they're almost, impossible to see. So that big yellow arrow is the gap, and these companies are gonna have to go out and start acquiring, to replace reserves. It's that simple, because they know that the requirement for production is gonna be there, and their reserves are being depleted. So that's why we're here today, to talk about opportunities. American Pacific, focused on high-grade assets in the western US. They've partnered with Dowa, Minings and Metals. They have the largest smelter out of Japan, a $2 billion a year revenue, 14 million ton VMS deposit in Alaska. This summer alone, $20 million in exploration, 17 of that funded by the Japanese partner. American Pacific is fully cashed up for 2 years. Michael Gentile, very, very savvy investor, resource investor out of Montreal. Really, draws attention when he takes a meaningful position in a company. Owns 13% of American Pacific. American Pacific has been nominated for multiple industry awards, including Deal of the Year and CEO of the Year. So look at American Pacific, go and talk to Warwick. You've got to get to know them better. Cantor Resources. They're targeting a major lithium and boron brine discovery in Nevada. They have a huge land position near Tonopah, which I know well for silver. Has an excellent jurisdiction for infrastructure, for access. Nevada, best place practically, or best place in the world to work for mining. They have widespread lithium and boron mineralization that's already been demonstrated. Columbus, that project came from the vendor who's supported over $1 billion in market cap for other lithium success stories. They have water rights, which are crucial, especially in Nevada. And the best comparable is Ioneer, that today has a $300 million market cap, and Cantor is at $7 million. So Ioneer's Rhyolite Ridge is just 17 miles away, has the same lithium boron commodity mix, same source rocks. Basically, they're neighbors. And the bottom line is that Cantor is targeting the next Rhyolite Ridge, but these are going to be in brines instead of in clays. Insiders at Cantor own 10%, and they've been buying. And if you look at people like Michael Gentile, once again, key strategic shareholders are looking at more like 20%. So management and key insiders have skin in the game. You always want to see that. They're also actively drilling this summer. They have a phase 2 program that's starting within about a week. So go and talk to Jonas. Lots to know more about Cantor. Just doing a tremendous job there as well. So to sum up, I see massive opportunity in the commodities space. Soaring debts, sustained inflation like the 1970s. I think we're entering a new commodity bull market. I think the first half of this bull market is going to be supply driven, in the sense that we've had so little exploration, so little mining capex. It's going to be sort of steady demand facing supply that's unable to meet demand. So more supply driven. And I think that, we're gonna hit a recession, we're gonna work through a recession. As always, governments are gonna stimulate by printing to get out of the recession. And on the back end of that, we're gonna have the second part of this commodities bull market is going to actually be potentially driven by demand outpacing supply instead of the reverse in the first half. So again, lack of capex, a new M&A cycle that is absolutely going to happen. And so the way to benefit from it is to target undervalued juniors with top assets. We have 2 of them here today. Sum up the entire thing. I published a book called The Great Silver Bull. It's all about the opportunity in silver. And if you want to follow my work, you can go to silverstockinvestor.com. I'm on Twitter and on LinkedIn, pretty active there. And if you have any questions relating to what I talked about, I'm happy to take them.
Do you have any silver stocks we should watch?
I do, but in fairness to my paying subscribers, come see me after.
Just any comment about, comment about what Silver's been reacting or acting to the last maybe week or so?
Yeah, I mean, it's interesting because I've been telling my subscribers, and this is documented, I even told S&P Global actually asked me that in an interview about a month or a month and a half ago. They said, what do you see, you know, over the next couple of months? And I said, silver has sort of peaked temporarily. It ran up because the market realized that the market is facing a structural deficit. And I said that run from $22 in February to $32 was too much, too fast. It's now digesting those gains, and I said we're gonna see 28 and probably 26 before it's over. And I think 20 either is a great time to buy, 26 of course especially is an even better time to buy. But I think that is gonna be close to the bottom, and that we'll see it start to take off this fall. I think we can see sparks fly in the precious metals.
You see real estate correlated to inflation?
Yes. Well, rates especially, right? So we all know real estate's bought with mortgages for the absolute vast majority more than ever. So when you have high rates, real estate suffers, and some people think that it's one way up. It's funny how we have short memories. You know, look at what happened in the U.S. That's what technically, officially caused the financial crisis, right? These mortgage issues. That's 15 years ago. People seem to forget. So, you know, high rates are going to start to have an effect, and a lot of people here probably remember. I certainly do. 1980. People were paying 20% on their mortgages. They managed, they did it. But cost of living, despite high rates and inflation for a decade, were still, you know, doable. Today, I'm not sure that's the case. I think people are living on a razor's edge, and you know, budgets are much tighter. And I think higher rates, despite central banks, I believe at a point where they're going to start cutting now. I don't think that, I think the effect of even this sort of small, rate hiking cycle from almost 0 to 5% is going to have a very detrimental effect, and it's going to show itself over the next couple of years.
Price of copper has come down, let's for argument's sake, about 10% recently. The fact that silver is sometimes regarded as an industrial commodity, that copper decline indicated that we're sort of in recessionary waters here. Can you just comment on silver in the recessionary waters?
Sure. I mean, I've looked at research. Silver underperforms gold in a recession. It outperforms gold on the way out of a recession. And so if you break down a recession into sort of 5 phases, the sort of period just prior, the early part, the middle, and then the end, and then the part coming out of it, it outperforms at the beginning and it outperforms at the end. You know, we can only go by what we've seen and make assumptions, but so much of this energy transition is mandated. And you know, if you look at what happened coming out of the financial crisis, there was obviously a lot of money printing, and what was most easy to justify to the citizenry was infrastructure programs, because you can argue that everyone benefits from an infrastructure build-up, and things like green energy and renewable energy. People don't seem to have much difficulty accepting. So if you say, we're giving subsidies for EVs, we're giving subsidies for solar panels, this takes a lot of silver. I mean, we're at a point now where just solar panels take 20% of the annual silver supply. It's the single biggest industrial application for silver. It's unreal. From 2022 to 2023, the forecast was that silver would, the demand for silver from solar would grow about 20%. It grew 64%. We're at a point now where they think that within 5 to 10 years, it's not likely that it will pan out that way, but the projections are that solar alone can take up all of the annual solar supply. So something else is gonna have to happen. So it's very positive for silver, but you can't deny that historically, silver struggles early on in a recession. So that's something to keep in mind.
But Kodak never bought a silver mine, right? Kodak.
I don't know.
They looked at one.
That's
They
all right.
never bought it.
So I think the stat is that about 70% of silver production comes as a secondary product of mining. I think it's in that ballpark. And I've also heard that that's been declining the fastest because the grades are just the deeper they go, the grades of the silver are less and less and less. Is there any current numbers on how fast projecting that out, what that looks like?
I haven't seen anything on that, any research on that. You know, what I can say is an interesting comment. This was from a mining executive who's been involved in large, quite, successful build-outs. Said silver is very, very particular when it comes to this, because more than 70% of mined silver is a byproduct. That means you're relying on companies that mine other things to get that silver, right? So if you see the price of silver go up, first of all, those miners don't care that much that the silver price went up. It doesn't affect their bottom line that much. They'll accept the higher price very, very gladly, but they're not gonna try to produce more silver because the other metals are, more key for them, more primary. So you can argue that in a higher silver price environment, you get less silver because even a primary silver miner will try to high grade. So they'll actually try to produce silver from their higher grade part of their ore and perhaps produce less silver and make the same profit. So it's all over the map. It's really, anything can happen.
Warwick, what's the deal in Palmer for silver and Montana?
Yeah, it's busy on both fronts. Just finished up drilling in Montana. Spent about $1.5 million down there in this first phase. Spending about $17 million, $17.5 million up in Alaska. So first drill results will come out of Madison. We decided to get those out probably end of August, beginning September. Right after that, it'll dovetail into Palmer. So from here till the end of the year, we'll be putting drill results out on both high grade assets in the western U.S. Both can create excitement. Certainly with more initial assets, so we get those assays out pretty quick here. Oh, and fully cashed up. We've got 2 years worth of cash, so we can strong position with that standpoint.
Reading some of that now.
A little bit.
Peter, you mentioned that the one chart you put up, you had 1,400% increase in the price of gold, 3,700% increase in the price of silver. How much of that 3,700% would you attribute to the Hunt brothers? Artificial.
Right. A lot of that came at the very end. Silver was in a really strong bull market for most of that decade anyways. And, I would say a few 100%, maybe at the very end. That blew up, and if you look at the average silver price for that entire year when silver peaked, it was still over $30, and it peaked at 50. So they had some effect, right? And even the year prior, it also averaged at quite a high number. I don't remember what it was. So they certainly had an effect, but I think that even without them, we would have seen a tremendous run in silver. And we know also historically that silver outperforms gold in bull markets. So, that the 70s is the best analog that we have to where I think we are now. And so I think we'll see silver outperform gold. It's just that a lot of that tends to come at the tail end.
Fast forwarding 50 years, if you look in now we've got $28, $29, $27 silver, $4,300 gold. We look at the earnings yield of the producers, they're still minuscule. At what point do they become real? And do we start seeing some of the returns to shareholders?
You know, when you have the underlying commodities move up significantly and relatively quickly, that tends to go to the bottom line almost completely. I know, they're also facing cost inflation. So it's tough for a producer too, and in some cases, depending where they operate, they're facing, a currency that may be going against them as well, like have been happening in Mexico, for example. That's somewhat reversed already, but there is a time. I think it's getting closer. I think that, you just have to look back at 2000 to 2010, 2012. That was a tremendous run. I think we're in for a repeat. It's probably gonna be even better. I think, people really underestimate how far, it's funny, I was talking to someone, this would have been 2004, 2005, a banker, and I was telling him, I think gold's going to $2,000. And he was almost laughing, saying, oh, you don't want to live in a world where gold is $2,000. And I said, okay, maybe not. We'll see when it gets there. But I'd rather own some, if it goes there, than not own some, right? And here we are, we're at 24, we're at, pretty much at 2,400. So I think ultimately it's going to at least 5, honestly, more realistically, probably double that. And I think that, if anyone who doesn't spend enough time looking at this stuff and understanding it doesn't grasp it and doesn't see that. And so, I've been saying since 2009 we're going to see $5,000 gold, and we're halfway there. And then some people, very, very serious, well-researched analysts are saying numbers much higher than that. And so, a few years ago they were considered kooks. Now people think that they're more realistic.
I've heard people talk about crypto as a monetary reset. What kind of monetary resets would you think should be possible?
I think that governments like fiat too much, and it gives them too much power. That's not going to be given up very readily. So I think central bank digital currencies are something they're absolutely going to roll out. I believe that's a concern because we all know what the implications are. But I think that we're going to get to a point where the reset to some kind of hard assets to back. I mean, we're seeing that with African countries now. One by one, they're saying we're going to use gold to back our currency. And 10, 15 years ago, there would have been a lot of blowback. Now it's almost, it makes the news, but there's almost no reaction in terms of, their neighbors or anybody else putting pressure on them to back down from that. So I think that the day will come, when hard assets will in fact be used. The obvious ones historically are gold, silver, maybe Bitcoin in some form, as we go forward. But I think that's going to happen as a matter of necessity, not as a matter of will on the part of governments and central banks.
The inflation numbers being reported are really, when you use some charts like this, are really underestimated.
Absolutely. I think, at any given point in time, you can easily double the inflation number and you're probably still being conservative. There's so much massaging going on and so much resetting and so much sort of leaving this out and leaving that out to make things look palatable.
Better than they are.
Right. That, we all know better. Right? We eat, we drive, we travel, we live, you pay rent, you pay mortgage, we all know. it's a much higher cost of living than that.
So back in the eighties, they had like a substitution.
Exactly, it's just convenience, yeah.
Have you done any work on nickel? That one's not looking so good.
Yeah, it's not something that I follow, I don't have much to say.
Peter, I'm gonna toss a salad at you here. You mentioned the African stuff. So here's the salad. The BRICS, okay, the African stuff, the debt of the, let's call it Western nations, and that, how's that all gonna mix up and sort of come out here? I mean,
Yeah, I mean, that's a really big question. I mean, what I can say is that I don't think that the dollar, the US dollar is gonna, sort of fall from its dominance that quickly.
it can't.
I don't think so, exactly. I mean, I don't know if you, remember the guy, Brent Johnson, who came up with something called the dollar milkshake theory. So if you look that up, you get his explanation. He's got some very, very good arguments. He manages money for high net worth clients. And I pretty much subscribe to, his view, which is that if you ask any big company today, if you've got a trade with somewhere else in the world, you're gonna take the yuan or you're gonna take the ruble, you'll take the dollar first. And that's not likely to change for quite some time. Our companies and our countries and central banks and sovereign funds trying to move away from it, absolutely. But I think it's going to be a gradual thing. I think that, it's gonna happen in more or less a controlled way, but then at some point, likely, some kind of a crisis will happen. He believes that the dollar will initially shoot up because people will go to it as a haven. And then right after that, it'll tank and remain into gold.
Missed the punchline.
Well, there are no more questions?
Thank you.
Thanks for being
Thank you everyone for coming. Please feel free to have another drink or two. I believe there's going to be more food coming around. Thanks to everyone for coming, and thanks Peter for sharing your wisdom with us and stepping in last minute for Peter Greenwich.
Basically,